Welcome to The Explainer. Today, we're diving straight into a massive, overarching theme that's basically defining our financial lives right now. Looking at a mountain of recent data from TransUnion, Bankrate, and the American Academy of Actuaries, a pretty startling conclusion emerges. The 2026 economy is moving in two completely different directions at the exact same time. Depending on where you stand, things are either looking better than ever or they are getting incredibly difficult to navigate.
So, are we living in two totally different economies? Honestly, if you feel like you're navigating a split reality right now, you absolutely aren't alone. Financial experts have started describing our current environment using a very specific term, the K-shaped economy. We're going to unpack exactly what that means and, more importantly, how it's showing up in your credit cards, your housing prospects, and even your retirement plans.
Here is our roadmap for today's Explainer. We'll cover our divided financial landscape, the consumer credit split, the 2026 mortgage market, gig worker retirement gaps, and finally, navigating your financial future. Let's get right to it.
Section 1. A divided financial landscape.
All right, here's our foundational concept. A K-shaped economy is, well, exactly what it sounds like. Picture the letter K in your head. That top arm pointing up, that represents a segment of the population that is thriving, recovering financially, and building real wealth. But that bottom arm points down. This represents another segment of the population that continues to struggle with mounting, compounding economic pressures. Basically, the most financially secure groups are accelerating, while vulnerable groups are facing heavier and heavier burdens.
Moving on to Section 2, the consumer credit split.
Look at this massive disparity in non-mortgage debt-to-income ratios, or DTI, from the end of 2019 to the end of 2025. For super prime borrowers, that's the top tier, their DTI barely nudged. It went up just 29 basis points. But look at the subprime tier. Their debt burden surged by 143 basis points. Everyday expenses are rising across the board, sure, but subprime borrowers are having to take on much heavier debt loads just to keep their heads above water, while superprime consumers are easily absorbing those exact same costs.
And wow, this leads us to a truly staggering number. As of the first quarter of 2026, the total credit card balance in the United States hit a record-breaking $1.12 trillion. That's a 4.6% increase year over year. Borrowers are relying on credit more than they ever have before. But, as we literally just saw, that trillion-dollar burden is absolutely not being carried equally across the economy.
Now, you might be thinking, well, surely lenders are pulling back on card issuances to struggling consumers, right? Actually, scratch that. Not true. Originations actually hit record highs. But look closely at the credit limits on those new cards. Lenders are giving deep subprime borrowers limits of just $678. High subprime gets about $1,034. Meanwhile, superprime borrowers are handed average credit limits of over $12,500. So lenders are definitely still in the game, but they are strictly managing their risk by drastically lowering the limits for vulnerable borrowers.
Section 3. The 2026 mortgage market.
Talk about a wild ride for housing, right? Back in 2020 and 2021, the Fed slashed rates to zero, and we saw 30-year mortgages drop below 3%. It kicked off a massive housing boom. Then, bam, inflation hit. By late 2023, rates had skyrocketed, peaking at around 8%. Now, here in 2026, Bankrate forecasts that the 30-year fixed rate will bounce around 6.1% for most of the year, potentially dipping into the high fives.
So, we are staring at two starkly different realities in the 2026 housing market. On one side, you've got the locked-in homeowner. They bought or refinanced in 2021 and are sitting pretty with a 3% rate. On a $400,000 loan, their payment is less than $1,700 a month. Life is good. On the flip side, you have the 2026 aspiring buyer. They're facing a roughly 6.1% rate, persistently high home prices, and massive affordability hurdles. If they tried to borrow that exact same $400,000 today, their payment jumps to nearly $2,400 a month. It's a completely fragmented reality.
But hey, there is a silver lining for a very specific group, perfectly captured by this classic piece of real estate irony. Marry the house, date the rate. If you were one of the folks brave enough to buy a house in late 2023 when rates were pushing 8%, well, 2026 might actually be your year. If rates dip below 6% as forecast, you finally get the chance to break up with your old rate, refinance, and significantly lower your monthly financial burden.
Section 4. Gig worker retirement gaps.
To really grasp this workforce divide, we need to define the gig worker. We're talking about individuals engaged in non-traditional work. Think your rideshare drivers, freelance graphic designers, or platform delivery folks. They operate outside the regular employer-employee relationship. As the actuaries point out, this is a rapidly growing segment of our modern workforce. But they're also highly vulnerable, largely because their legal classification as independent contractors is just constantly shifting at both the state and federal levels.
You know, the independent, self-driven nature of gig work is incredibly appealing. Be your own boss. But the harsh reality is that the freedom of the gig economy often comes at a severe cost. Because they aren't classified as traditional employees, most gig workers simply don't have access to a traditional safety net. They are completely locked out of employer-sponsored 401k matches, automatic payroll deductions for retirement, and workplace financial education. They have to navigate the whole shebang entirely on their own.
So, here's where things get really tricky over time, especially regarding taxes. The actuaries highlight what we can call the $20,000 reporting trap. In 2025, the reporting threshold for 1099-K forms, those are the tax forms used by payment apps and online marketplaces, was reestablished at $20,000. Because that threshold is relatively high, a lot of gig workers might not receive a tax form at all. Consequently, they might underreport their income to the IRS. While keeping that cash might feel like a short-term win, it is a massive trap that directly and permanently slashes their future Social Security benefits.
To put that into perspective, the long-term penalty of underreporting is absolutely brutal. Imagine a worker who earns $64,000 a year. If they report their full career income, their estimated annual Social Security benefit at retirement is $37,800. Great! But if they fall into the trap and only report half their income, their benefit plummets to $24,800. And if they report nothing, they get nothing. $0. This is a devastating hit to retirement security for folks stuck in the bottom arm of our K-shaped economy.
Finally, Section 5, Navigating Your Financial Future.
On a systemic level, the Academy of Actuaries suggests that the Social Security formula could theoretically be adjusted to better support low-income and gig workers. They propose 3 complex but really powerful steps. First, increasing what's called the first earnings bend point, so lower-income workers get a proportionately higher benefit. Second, providing dropout years so a few years with zero earnings don't just completely tank a worker's lifetime average. And third, simply raising the minimum benefit amount to keep vulnerable retirees above the poverty line.
We're also seeing some really cool emerging legislative solutions, like portable benefits. Utah is actually leading the way here with an innovative law called SB 233. This allows companies, like app-based platforms, to voluntarily contribute to a benefit fund for gig workers without legally classifying them as employees. The brilliance here is that the benefits are portable. They literally follow the worker from gig to gig. It allows independent workers to build security for health insurance or retirement without losing their independence. Other states are starting to look very closely at this model for sure.
But what can you do right now to bridge the gap? Here are some quick, actionable takeaways to take control of your position today. If you're braving the housing market, comparison shop at least 3 to 5 lenders, because rates vary wildly right now. Whether you want a mortgage or a new credit card, aggressively work to bump your credit score above 780 so you can get into that super prime tier. Focus hard on paying down high-interest, non-mortgage debt to lower your DTI. If you are a gig worker, report your full income. Please don't fall into that $20,000 trap. And lastly, if your state happens to offer an auto IRA program, take the initiative and self-enroll.
As we wrap up this explainer, I really want to leave you with one final provocative thought to chew on. The data is crystal clear. The economy is splitting and the middle ground is shrinking fast. So take a hard look at your finances today. Where do you stand in the K-shaped economy? And more importantly, what's your next move going to be? Thank you so much for learning with me today, and I'll catch you on the next explainer.